Art Collins here with the Bitcoin Moving Average Cross Overnight System. Set your chart to 24-hour daily bars, 5 p.m. to 4 p.m. Central Time. So that would be 5 p.m. on Sunday through 4 p.m. Monday. That's your first bar. Your last bar is from 5 p.m. on Thursday to 4 p.m. on Friday. The first session in a row that the 4-day average close is above the 7-day average close. Go long on the next 5 p.m. open plus 66% of the average 3-day range on a stop. The first session in a row that the 4-day average close is below the 7-day average close. Go short on the next 5 p.m. open minus 66% of the average 3-day range on a stop. Hold the trade through the remainder of the 24-hour session and exit on the next session in one of three ways. Take profit on session 1's high if long or session 1's low if short on a limit order. Set a stop loss order 1 tick below session 1's low if long or 1 tick above session 1's high if short. Or if neither side is hit, exit on the 4 p.m. session close. So since we're dealing with unwieldy 24-hour sessions, which overlap an evening, you're technically not sure of what your outcome is going to be over 2 nights. You may actually be in the trade for over 2 nights if you enter it sometime between 5 p.m. and midnight. But at the very least, you're going to have orders up through 2 evenings, or an order or an actual position up through 2 evenings. For the first day in a row, the average 4-day close, blue, can barely see that it's higher than the white 7-day average close. It's the first day in a row that happens, so you go long on the next open plus 66% of the average 3-day range on a stop. And again, let's say that this is Tuesday. You might have gotten in before midnight on Monday, so you might have been holding this trade over 2 nights. Here, the first session that the 4-day average close in blue is below the 7-day average close in white. Go short. The open minus 66% of the average 3-bar range on a stop. Okay, now I have no choice but to show you the results on the humongous big contract, which is actually 5 times the size of the underlying cash. Because if I just did it the logical way on the micros, and we could, do the multiplication on how many contracts we wanted to hold, that would make the most sense. But unfortunately, micros do not track in TradeStation. The fraction of the point or whatever is just too small for it to register. So this is a full-size contract. For your information, that'd be about $118,000 in margin you'd have to hold just to trade it. To get to the basic unit in the micros, you divide these numbers by 50, you divide this by 50, this, and I can divide this by 50 too. Divide by 50 also. The other stuff are ratios. They stay constant. So big boy, 5 times the size of the cash, $168,400 net profit off 94 trades, 67% were profitable. $1,791 was your average trade. $18,775 your worst drawdown. Not so bad. When you divide this by 5, that would get you to the cash contract size, or by 50, getting you to a micro. And whatever frame you're using, the return on account was a pretty substantial 896%. More good ideas and beating the financial futures market, the 2025 Almanac. Reach me at art@artcollinstrading.com. Thank you for joining me.